right, welcome everyone. Just getting started. Give a few minutes to get connected, and then we'll get started with the show. Tuning in, feel free to drop a chat. Saw a few people in there before we started. And we'll get started in just a minute. Good morning, everybody in the chat. Give a few more minutes to go live on all the platforms. Looks like we're live on YouTube. I see y'all commenting. Thank you very much. Give it a minute. We'll go live on LinkedIn and Facebook and all the other platforms as well. All right. All right, we should be live on all the platforms now. Usually takes just about 2 minutes. So thank you everybody for tuning in. Let's go ahead and get started. So thank you everybody for joining us today. My name is Nick Hiersche. I am the president of the Mortgage Calculator. We are a lender that specializes in non-QM mortgages and alternative income documentation. And one of those amazing programs that we have is our short-term rental property DSCR, which Jose will talk about in a little bit. So Jose, our sales manager with 27 years of experience, will go into a deep dive on these specific short-term rental property loans. We have a few different options. I'm sure Jose will go into a few different ways to look at this, but usually the DSCR using short-term rents is what we're looking for. That is something that's unique and special. So we'll get into that a little bit later. But as we do every morning, we're going to check out the live rates on all of our standard programs. So we love to do non-QM loans, but we still obviously have access to all the conventional, FHA, VA, USDA, and all of the other amazing programs that are out there. So this morning we will check out the rates on our live pricer, and then we'll get into the deep dive topic with short-term rental properties. So without further ado, let me get into the rates today and switch my screen. Give me 1 second. So this is our pricing tool for our mortgage professionals. This is something that they use to get the pricing indications. So today is April 20th, just after 11 a.m. Eastern. So our basic program rates are live here now on this pricing tool. This is going to show us the general rates and APRs that are available. If you'd like a full loan estimate with a full breakdown of all the itemized charges, please get with one of our 300 plus licensed loan officers. We're licensed in 22 states for primary and second homes, and we can do our DSCR business purpose loans like the short-term rental property DSCR that Jose will present at the end here in 44 states. So pretty much every state on those business purpose loans. But this tool we're going to use to set up some basic scenarios to check out the rates this morning. We're going to set a nice easy loan amount of $400,000. We're going to set an LTV to 80% loan to value. That means 20% down payment. We're going to set desired price to 99. That means we're going to tell the computer find the best rate at one discount point in cost is our request. Most of our customers are asking to buy down the rate a little bit in this a little bit of a higher rate environment we're in right now. So that's our typical request. We're going to compare our loan types. First, we're going to conforming conventional. Then we'll check out our FHA rates this morning, and then we'll go into our expanded guidelines, aka non-QM, where we have over 5,000 additional loan programs where we can use alternative income documentation. Now, remember, VA is only for eligible veterans, so we don't do that live. If you are an eligible veteran, we appreciate your service and would love to quote that for you, but since not everybody is, we don't always pull those rates up live. And same thing for USDA, that's only for eligible property in a USDA eligible area. So if you do happen to be shopping in a rural area and looking for a USDA loan, we'd be happy to quote it, but since not everybody is, we don't do that live. So let's start first with our conforming conventional. we're going to set a purchase, 30-year fixed, standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. For all of our estimates today, we'll use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So with those basic settings, let's check out our conventional rates this morning. So we're down a touch, I believe, from yesterday with a touch higher. So that's good. We love to see the movement. That's why we do this show every day. So right now, the computer found the best option, 6.5 rate for 1 discount point in cost and a final APR of 6.676. So remember, the APR includes all of the borrowing costs. And so that allows us to compare across programs. So when we're comparing across these few different programs, please make sure to key in on the APR here, and we'll use that to compare directly across. Now, if for any reason our customer in this case doesn't qualify for conventional, which is usually the first option, let's go back to the quick pricer. We'll set up the same exact scenario. Usually the next best option is an FHA program. FHA does have a little bit more relaxed guidelines on a lot of credit type of things, and of course a higher DTI that we can take the loan to. So everything else will stay the same. And let's compare our FHA rates this morning. So now obviously FHA is going to have a lower rate, but there is a yearly mortgage insurance and an upfront mortgage insurance. So here we have a 5.75 rate for 875 discount points, 0.875 discount points in cost, and the final APR of 6.348. So remember, the APR there for the conventional was just over 6.5. Right here, FHA is actually a little bit lower for this scenario. So typically FHA in the past has been a little bit higher on the typical scenario. In this case, for this borrower, FHA is actually a little bit cheaper. So definitely recommend for all of our MLOs out there, don't discount FHA. With some recent improvements, it's a great option. And for all of our borrowers out there, definitely recommend you compare both side by side because FHA might be a touch cheaper in this situation. Now, if for any reason our customer doesn't qualify for FHA or conventional, that's where many other banks or lenders do not have other options, but that's where we love to shine here. So at the Mortgage Calculator, we have over 5,000 additional loan programs under expanded guidelines, whereas some other banks might not have any. So expanded guidelines means non-QM, and we're going to set everything else the same, but we have one new option that pops up when we choose non-QM programs, and that's our income verification because we can use alternative income. So full doc is what we have to use for FHA and conventional. That's 2 years of tax returns, what everybody's used to. So typically we'll choose one of these programs to choose a different option. So 1 year alt doc, popular 2 year alt doc. We have asset related programs where we don't actually need employment. We just use assets. Business bank statements programs are very popular. For investment properties, the DSCR is very popular. Personal bank statements is what we're priced right now. We also have 1099, P&L, etc. The most popular option is the 12-month personal bank statement option. And that's going to be for our self-employed borrowers who many times on their tax returns have various write-offs and for various reasons may not quite get the income that they need or may not qualify at all. So in this case, instead of using 2 years of tax returns, we're simply going to get the most recent 12 bank statements from this borrower to then analyze those bank statements in the cash situation of the borrower to determine a debt to income ratio using those bank statements rather than tax returns. And for most of our self-employed borrowers, they qualify for much more income and therefore a much larger loan amount and can actually get that home that they're dreaming of. So this is a solution for our borrowers. These non-QM programs will have a little bit higher rates, but remember, this is a solution where we would otherwise have no other option. So let's check out our non-QM bank statement programs this morning. Woo! We got some downward movement, Jose. This is good. Check it out. So yesterday we were at just over 7. Right now we're at 7 with 1 discount point in cost for a final APR of 7.080. So remember, the conventional was just over 6.5. Now non-QM is coming in using bank statements, totally different ball game, coming in very comparable at just a hair over 7. Definitely recommend our customers out there always consider both options. That's why we love to quote at the Mortgage Calculator all the different options for our borrowers because there could be a great option in here that would solve a lot of problems. Now, if you look down here, we have hundreds of different versions of these bank statements and alt doc programs. Some of them at higher rates may allow things like a recent foreclosure or credit event. So lots of flexibility here. Once we go into the non-QM space, please get with our team. They'll find the one that fits best for you. So now, before we go into our deep dive, we always want to do two more live rate scenarios, and that would be for our investment property. So we love to work with investors here at the Mortgage Calculator. Whether it's your first investment property or you have 10, 20, 100 properties, we love to provide those options. So let's set up our basic scenario. 80% loan to value, same as before, 20% down payment, same price as before. And we're simply going to compare our investment property options. We will have conforming conventional loans, and we will compare that to our expanded guidelines non-QM. Remember, FHA, VA, and USDA are not eligible for investment properties, so we can simply compare these two options. We'll select conventional first. Everything else will stay the same as before. All we did was switch it to investment. So let's check out our investment property rates this morning. So the computer, as I say every morning, is typically unable to find a option for one discount point in cost. The GSEs that do conventional loans, they have added basically penalties to investment properties. So the best option the computer found here in this case, 6.875 rate for 3 discount points in cost for a final APR of 7.118. So because of these additional costs for investment properties, these quotes will have a lot of points. Many times our investors want to find an option even at a higher rate with less points. So unfortunately with conventional, even if we cruise down the sheet here, we try to find a higher rate option. This is a good example here, 7.49 rate for 2.375 discount points, a little bit higher APR, but our investors typically want to save cash out of pocket. In this case, 2.375 is still a lot of money, right? $10,000 that they could deploy elsewhere. So that's where we love to offer solutions, which our non-QM loans offer. So if our investor here qualifies for conventional and they want this program, great. We would love to offer it, but I definitely recommend our investors check out our other options. So for our final live demo, set 80% LTV again, set investment property, and this time we'll set it to expanded guidelines, aka non-QM. And this will pop up 2 new options that we need to set. First, our income verification. When we're using an investment property, the most popular option by far is going to be our DSCR investor option. And that's because it actually doesn't require any income from our borrower. No employment, no income from the borrower. We're simply going to use the estimated rental income from the property to determine if that rental income can cover the expenses, the PITIA of the actual property, this one mortgage that we're doing. If the cash flow from the gross rents can cover the expenses of the mortgage, the PITIA, that is a ratio greater than 1. So here's the DSCR ratio here. We even have options where the property doesn't quite cash flow, a ratio under 1, where the property doesn't quite cover all those payments. There's still options there. Now for our demo today, so we get the most options, we're going to set the DSCR to 1.50. So in this scenario, this would be a property that cash flows very strongly. Now the other option that we always must set on a non-QM investment property is our prepayment penalty. That is pretty standard. We always select 3 years for our demo. Remember, we can select 0 if that's required. That will limit our loan programs and cost quite a bit more. We could also select 5 years if we wish. That will cost less, obviously save some money, but there's not as many loan programs. So for the most common option, we always choose 3 years. That is most common for an investment property non-QM loan. So with all those settings set, let's check out our DSCR rates this morning. So we love to see rates in the 7s here, some great options. So right here at the top, great option, 7.5 rate, 0.725 discount points. So remember, in our example, this is about 10,000 less out of pocket for our investor that they can then deploy that cash elsewhere into other investments. So this is a solution for our investor that wants lower discount points. And if you cruise over here to the APR, we see an APR of 7.571. Very comparable, just a touch over the conventional. Remember, the best conventional APR we found was about 7.1. So these DSCR options, no employment, no income. You can do multiple loans at the same time, cash out multiple properties, buy multiple properties, not have to worry about employment or income, and all just for a slightly higher cost. So definitely recommend our investors, always consider our DSCR options. And if we scroll down here, you'll see we have hundreds of different options with various DSCR ratios, various prepayment penalties. Some of these options at a higher rate may allow things like short-term rental income, which is going to be our next topic. So this is a good segue into our actual topic for today, where Jose is going to go into one of these many dozens of programs to show you guys the secret options that work for our Airbnb, short-term rental properties, VRBO, whatever you want to call it. So let me go ahead and switch my screen and we'll introduce that topic and get into that for today. So as I just briefly talked about, our topic for today going to be short-term rental property loans. So many people out there, obviously very popular, VRBO, Airbnb, whatever your platforms you use, it's all short-term rental properties, right? So short-term would typically be anything under 6 months, right? Many leases can be 6 months, many leases can be 1 year. Those would be long-term leases, right? Anything less than that, and typically less than 30 days for most municipalities. Obviously, there's certain definitions in certain states and municipalities, etc. However, typically short-term rental properties would be under 6 months and typically even under 30 days. Once someone stays 30 days in a home, sometimes they get additional rights. So when we're talking short-term rental properties, we're talking no long-term lease, we're talking short-term rents, and typically what most people, I'm sure on this call, would call an Airbnb loan as the more common nomenclature. So tons of different options, tons of just different ways to kind of crack this and approach this problem. So Jose, you got a few examples for us there about how we can approach this for our investors.
Yes, sir. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. DSCR is our flagship program, and short-term rental DSCR options are definitely one of our strengths. Where I really feel that the Mortgage Calculator excels is in our interpretation of all the guidelines and how we apply them to real world situations. And it definitely shines when we're talking about our short-term rental options, because what we're really looking at here is the interpretation of how you reach the monthly rental income. That is what you use for your debt service coverage ratio, right? There are a number of options that we can use, and like AirDNA, short-term rental revenue reports. We can also use long-term rent. We can use leases. So there's a number of ways to arrive at the monthly rental income that are acceptable. But you have to know that not all of these options are accepted by every single program out there. They all, as we know, the non-QM world is very specific on their guidelines. Each investor is going to have their own tweaks to the guidelines. So we can't just say for all DSCR loans, this is what you do. And this especially holds true when we're talking about properties where the income is going to be generated by short-term rentals, where there is not a lease, a permanent lease on the property. So that's issues that would definitely be in play if this was a refinance, for example. You know, there's some options that if the property is not leased, they consider it a vacant property, and then you are subject to LTV restrictions, and in some cases they won't even do the loan. So hence it's so important for us to dig deep into those guidelines and see how the rental income for the property is actually determined and what are the acceptable methods of doing so. And in our doing this, we've been able to formulate our short-term rental program using DSCR loans. So my first example here that I have is for a purchase, 20% down. And I'm separating my quotes into AirDNA option and non-AirDNA option, because that's a very critical distinction there. Because AirDNA, for those of you that may not know, is a database compiled by obviously Airbnb, right? Where they basically have all the data of the activity, sort of like, you know, realtors look in the MLS for rental comps. Well, You can look in the AirDNA database for short-term rental comps that have rented through Airbnb, and based on that, you can establish short-term rental comparable projections for a property when you're purchasing it. Now, keep in mind, AirDNA is only applicable for purchases. You can't do it for a refi. If it's a refi and it's short-term rental, then you're going to have to provide, depending on the guidelines again, short-term rental revenue reports. In some cases, they have to be for 12 months. In some cases, you just have to put it on the 1007 and they'll take it at face value, because some of our options just say they'll accept the 1007, they'll accept short-term rental revenue reports, or they'll accept if the appraiser just simply puts it on the 1007. Now, mind you, putting those short-term rental comps directly on a 1007 is sort of like finding a unicorn, that needle in the haystack, but I have had it happen. You just have to be persistent because it's a little spotty on the application by the appraisers themselves. Some are still stuck in the pre-short-term rental era, and their mind hasn't really opened up to all the different ways that we as lenders are evaluating income. So keep in mind, it may take sometimes 2 or 3 attempts dealing with your AMC to get the report right. So that is the challenge. It's not like 1, 2, 3 and it's going to happen when you're trying to directly get short-term rental comps on the appraisal. So I wanted to give you a little context so in this non-AirDNA option, excuse me, when we're using short-term rental revenue reports, which can be provided by the seller, right? This option does allow us obtaining the revenue reports from the seller, because in essence, they're not really looking at like experience level from 12 months experience level from the borrower, which is what some options look for when you're using the short-term rental revenue reports. They want to see 12 months, not just for an average, but for experience level. So make sure you look into your guidelines and make sure that additional requirement isn't in place. So our example here with 20% down using short-term rental reports, or if you can get the 1007 to have the actual short-term rental comps, you're looking at 8.5% with a $900 lender credit. That's really good. And 7.625 is the rate, the lowest rate option at just under 3 points. So this is our 20% down option. And now we have the same option, 25% down. So you can see now the rate gets substantially better. We have 8.25 with a $1,547 lender credit as our lowest cost option. And you can buy it all the way down to 7.375 at just under 3 points. So now we have our non-AirDNA cash out option. Again, same scenarios and how you can arrive at the income. Keeping in mind that when you do use the short-term revenue reports for this particular option, they cap the income, and this is applicable on the other 2 options I gave you. They cap the income at 115% of the long-term rent placed on the 1007. What that essentially means is you'll get a 15% bump above the 1007 using this option. That's the max they're going to give you. And on top of that, when you're doing the calculations, they give you a 30% haircut. So they give you 70%. Some give you 75. This option gives you 70. And then 115% of the long-term rent. So you got a couple of calculations to do there, but still looking at 8. This is done the cash outs at the max LTV DSCRs are maxed at 75% on a cash out for 1 unit. You're looking at 8.875 lowest cost option, and you can buy it down to 7.875. So now we're going to make it a little bit interesting, and we have some options using AirDNA. Now, keep in mind when you're using AirDNA, it may be subject to a 5% LTV reduction. So yes, they give it, but they take it, right? Now, but you have to consider, where is an AirDNA projection necessary? Okay, you're buying a property and this you're going to do short-term rental. The seller wasn't doing short-term rental. There's no revenue reports that the seller can provide, so that option is not there. So your options are basically the long-term rent from the 1007 or a short-term rental projection using AirDNA. Pretty cool. Um, in this particular scenario, the investor here is the one that runs the AirDNA. When I say the investor is who we sell the loan to, is the one that actually runs the AirDNA. So you give them the information, they run it, and they provide it to you. So that's pretty easy because now you know what the income is provided to you by who's going to be doing the final review on that file. So here you're looking at, notice the rates are obviously a little bit higher than our 20% down non-air DNA option, but again, that is all associated with the risk with using AirDNA projections. You may not use it on your file and have to pay the higher rate, but they're building in that extra risk into their loan portfolio. So you got 9.25 as your lowest rate option, excuse me, lowest cost option, but you can still buy it all the way down to 8.25. And if we compare this to our other option, you'll see here you're looking at 8.5 and 7.625 as opposed to 9.25 and 8.25, and a little bit of differences in the cost as well. So at a 75% LTV, now you see this rate is a lot closer to what we saw at an 80% on the non-air DNA option. But again, you understand where this would be used. And typically a good example would be a very expensive property that's going to make an amazing trophy short-term rental, but there's no way you're going to get those long-term rents to come in. This is the perfect solution. But keep in mind, when using AirDNA, there have to be comps. They just can't pull in stuff from 20 miles away. It's going to be similar rationale as when looking for comps on an appraisal. The area, you have to have short-term rental comps in proximity to the subject. So in this 25% down option, we have 8.5 and 7.5 as our lowest rate option. And then we'll give you a little cash out refi at the maximum LTV. And again, pretty good rates here. You're looking at 8.75% is costing you 33.75, and 7.875% costing you just under 3 points. So you'll note most of these rate options you're seeing here are pretty identical to the options you would normally find in a quote unquote regular DSCR loan, because that is what they are. We have just uncovered the ones through our review of guidelines that we can apply to this scenario, which is like what we do on all our loan products. Review the guidelines, find the best options that apply to the scenario, and then we run with it. So looking forward to helping you all structure your short-term rental loans.
All right. Don't see any specific questions. Someone said they dropped the video for a minute. That's about it. Definitely be careful with the quotes here, team. Remember, dig in those guidelines, as Jose said. They do vary greatly, right? So please check with Jose if you need some of these programs that allow these little tricky loopholes. But we have them, right? That's the whole point of us here at the Mortgage Calculator, adding all these great programs and all of these great kind of little tweaks on the programs so that we can solve the problems for our investors. Finally, a question here. Good. So Jason's asking for the AirDNA option, 20% down payment. Is that already with the reduction?
You would have to look at the guidelines and review. In this example here, it was already taken into consideration. We basically looked at the 80%, the 85, and got the 80.
Yep, good question though. So that's one of the things that trips people up, right? Because remember, if we have to use short-term rents, the LTV reduction kind of
Yeah.
kicks in. So we can also hack it by, guess what? If the long-term rents are usable, we don't even need to go down this pathway, right? So it's important to get with one of our teammates that can properly analyze this for you. Look at the long-term rents, look at the short-term rents, find the 30, 40, 50 programs we have for long-term rents, find the 5 or so programs we have for short-term rents, and structure that to find the best option, right? We don't always have to go short-term, even if the intention for the purchase is to rent it short-term. So a lot of ins and outs. Definitely pay attention here, team. And for those of you out there shopping, trust me, we have all of the ins and outs figured out on which directions to go. That's really what we specialize in. So let me go ahead and wrap it up here. So again, if you guys want a full quote, a full breakdown, and have one of our teammates analyze which long-term, short-term, AirDNA, non-AirDNA directions to go, please get with our team. You can go to themortgagecalculator.com, request a quote, or you can email us info@themortgagecalculator.com. We'd be happy to connect you. We do this show every weekday morning. Check out the live rates as they fluctuate, and then go into a deep dive on a specific product, such as our AirDNA, short-term rental property loans, Airbnb, VRBO, whatever you want to call it, all the great keywords that go into this new kind of industry that everybody's loving, right? This is probably one of our most popular requests, right, Jose, for these short-term rental properties. So great thing to learn about. We go into a deep dive such as this every weekday, and then we do our live trainings on Tuesdays and Wednesdays for all of our loan officers out there. So thanks everybody for joining us. We will be back here tomorrow at 11 a.m. for the Friday episode where we'll see where the rates end up for the week. Thanks everybody for tuning in, and we'll see you tomorrow.
Thank you, everybody.